All right, guys, let's go over the ES trading for today and make sure that you take a look at the previous videos that are on the Facebook page and the YouTube channel where I referenced all the lines in the sand for the ES for today. Let's start with the fact that we could not break this level up here, the green, the red, and the green, which was, we could not break it to the upside, which was Monday's opening range. So that was a bearish sign in and of itself. The opening range for today ended up reverting back to 2171, which was the opening range for Wednesday. Because we did not get an opening range signal today, we revert back to the most recent opening range signal. 2171 was just that. You could see when we got into the regular trading hours, we came up, right, basically like 3 ticks above that opening range and never saw it again all day. That is bearish. That is a bearish sign. And I'm not just talking about bearish for the very short term. I'm talking that there seems to be a shift here in sentiment. So these red lines here, as labeled by right here, the massive shorts, there's a boatload of shorts that were put on where these red lines are. And if you noticed, the bears were able to defend that all day long. That's another bearish sign that the bears are in charge. We came down. We came back up to where all the shorts were put on. They slammed it again. We came back up to where all the shorts were put on. They slammed it again. Came back up to where all the shorts were put on, and they could not break it out. That is bearish. Now, right now, the line in the sand for the the bears is to keep it below where all these shorts are. And this level right down here, 57 quarter, 57 even, if we break that, could be an acceleration to the downside. A lot of longs right here at 64 even were put on. So look for that to be a point of interest. But as you can see, once again, all these lines were instrumental in dictating exactly what to expect out of the ES during the course of the trading day. And us not making another opening range for the day also is a bearish indication. The 33 continues to just be stellar. We came right up to the 33 and in collaboration with where all these shorts were, and that's when they slammed it. Now, we got back above the 33 on the short covering rally right here, but we continue to break down below it, follow it up, break above it, and now we're right down to it again. So I don't remain very optimistic for the equity markets right now. It looks like we're getting, I'm not saying that we're going to get a massive correction. What I'm saying is we are going to get a pullback on an intermediate term basis. So keep your powder dry, and I wouldn't do any new buying, that's for sure. And I maybe on some more intermediate term positions, I booked some profits in this area. But that's pretty much where it stands right now. The line in the sand for the bears is to keep it below 69 quarter down to 68 half. That's where they need to. That's their line in the sand. And if we take out the 64 where all these longs got in on this little chop, about a 4-point chop, they're gonna sell with both hands. So keep an eye on that. And on an intermediate term basis, if we break 67 quarter, this thing could definitely be in trouble. So look, man, I mean, if you're not using the footprint, you have to. I'm telling you right now, it is the best way of looking inside the market and seeing exactly what the big boys are doing, at what price, who's in charge, how strongly they're in charge, if there's a transition going on, and so on and so forth. It doesn't matter really what degree of trading you're doing, whether it's micro, whether it's short term, whether it's intermediate term. It's imperative that you use these footprint charts. All right. Until my next video, you guys have a good one. Later.